From the virtual newsroom of Impact Alpha, this is your Impact Briefing for Friday, February 5th. I'm Brian Walsh. Today, I'm joined by Professor Tensie Whelan, Director of the Center for Sustainable Business at NYU's Stern School of Business. Her study of corporate boards found vanishingly few have experience to lead on ESG issues. Hi, Professor Whelan, and thanks for joining our podcast.
Hello, Brian. It's a pleasure to be with you today.
Great. I look forward to our conversation. But first, here's what you need to know from this week in impact investing. Biodiversity is the new climate change. Ecological collapse is not only an existential risk to humanity, it's also a global financial risk. The Dasgupta Review, named for the Cambridge professor who wrote it, painted a grim picture of extinction and degradation, but cited opportunities to shift capital and value natural assets. Only $13 billion in private capital goes to biodiversity each year, and 0 out of the 75 largest asset managers have a dedicated investment policy on biodiversity. Investors have discovered food waste. Last month, Imperfect Foods raised $95 million to distribute foods deemed too ugly for supermarkets. But such investments are just a drop in the bucket if the US and the world are going to meet stated goals of cutting food waste in half by 2030. In a new report, the nonprofit ReFed finds that there's a $14 billion annual investment opportunity and that investment could yield $73 billion. That's a 5-to-1 return. The cost of capturing carbon and growing meat in laboratories are dropping. The Canadian company Svante has cut in half the cost of capturing carbon from industrial processes, including manufacturing cement. Singapore's Temasek led a $75 million round of financing to scale up Svante's efforts. And Israeli company Future Meat has gotten the cost of its lab-grown chicken down to just $7.50 a breast, making it one of the first cellular meat companies to get close to a commercially viable price for meat grown in vats from animal cells. Food giant ADM and Tyson Foods joined a $27 million round to bring Future Meat to market. Impact Alpha subscribers got all of these stories and much more in The Brief, delivered weekday mornings straight to their email inbox. And one more note, on last week's Impact Briefing, my co-host Monique Aiken introduced Impact Alpha's newest podcast series, The Reconstruction. The first 3 episodes are up. Check them out at impactalpha.com/the-reconstruction. And now it's time for our featured conversation. Professor Whelan, you had a guest post in Impact Alpha this week headlined, "Corporate Boards Are Not Leading Companies Where They Need to Go." So why is the experience and expertise of corporate board members important? Why should investors care?
Well, corporate boards today are making decisions around important strategic objectives for the organization. They're also handling major risks as well as major opportunities for the company. And when you look at what are the material risks and opportunities for most industries today, there are significant environmental, social, and governance issues that boards need to understand and be able to ask the right questions around to determine whether the leadership of the company are actually tackling them in a way that will help that company both manage any risk, but also see how they can be, competitive and move forward on tackling things like climate change or diversity and inclusion or cybersecurity risk.
So what spurred you to do this study, this analysis of corporate boards?
Well, I have had some experience with boards myself, and I saw that many board members don't think that these issues are important. And I've heard this as well from employees within these companies that the board is not taking a leadership role. So I was curious as to what are the credentials of board members. And so we looked at the Fortune 100, 1,188 board members. We did the research in 2018 to understand what their credentials were around ESG and to understand whether they really could ask the right questions of their leadership. Because without having some background, I don't think people need to be climate change scientists, but if they have no history or engagement or interest in these topics, they're not going to be asking the right questions and focusing on the right strategic issues for the company.
So how did you evaluate the credentials of these nearly 1,200 board members?
Yeah, so we looked at environmental, social, and governance. We looked at what the companies reported themselves in company bios as well as in filings. So because we figured if they weren't including it as relevant, even if the board member might have some credentials that aren't being included there, they're not seeing that particular credential as important. So that's where we got our data from. And then we looked at environmental side of things. What kind of experience do they have? So somebody who's a former EPA administrator, for example, or a leader in the World Business Council for Sustainable Development has good environmental credentials. Or somebody who has worked in cyber risk and security, terrorism, might have good governance credentials. Somebody who has a strong background in engagement around diversity issues on the social side. So those were the types of qualifications we looked for.
So, when it comes to materiality, that's the material financial impact of environmental, social, and governance considerations. There is a real connection to financial performance here. And so, what is the risk that these companies face in not having this appropriate or necessary ESG experience on their boards?
Well, there's a growing body of research that is finding that those companies that are not tackling those issues that are material are underperforming those that do. George Serafman out of Harvard did some interesting research on this and found that stock performance in a large portfolio over time, that those companies that manage for their material ESG issues had an outperformance of 6%. You can also look specifically at companies that aren't tackling, for example, environmental issues. You can look at VW and their cheating on emissions, right? And so the strategy there was to avoid dealing with a major environmental issue as opposed to actually tackling it and getting out in front of it, which is what they've done now as a sort of reaction to not doing the right thing then. If we look at the insurance sector and you think about property and casualty and also human health, and we see increased extreme weather events affecting property, we see extreme, heat and drought affecting human health. Right? So there's a series of issues that if you're not looking at climate related to the impact on your financials as an insurance company, you're missing the boat. And another example, I've done a lot of work in Latin America and a lot of work on commodities such as coffee. And coffee is massively impacted by the significant changes in weather related to climate change. Productivity is down, use of chemicals is up. The places where you can actually grow coffee are getting less and less. So, again, if you're in coffee, second most traded commodity in the world after oil, and you're not paying attention to these issues at a board level and at a C suite level, then you're not going to be in business that long.
So, what are the implications then for investors? So what are investors and the shareholders in these companies to do about this dearth of relevant ESG experience on so many of these large company boards?
Well, I think investors are increasingly requiring reporting to SASB, the Sustainability Accounting Standards Board, so that you have at least some good data around what are the material risks for the company. I think they can also ask to see the company's risk register to make sure they're understanding the risks and managing for those key risks. But then, in terms of the board, as more and more investors are asking for diversity on the board, which they should do in terms of women and race, they should, or gender and race, they should also be asking for ESG credentials. And that, you can have those ESG credentials through training. You don't necessarily have to come into the board with them. So I would also be looking at what kind of educational opportunities have the board members been given in order to better understand the issues, the ESG issues for both the industry that they're in and the company that they're working for.
So we're entering soon the proxy season. Do you see any hot fights upcoming between shareholders and boards on any of these issues?
Well, we've seen that there's a number of investors in Exxon who are concerned about the way in which Exxon has really, for the most part, avoided dealing with climate change, disclosing important risks, et cetera. And there's been a variety of other efforts to bring Exxon to heel around those topics by investors. And most recently, we've seen investors like Engine Number One come in with a suggested roster of board members who have low carbon transition credentials, right? People who understand renewable energy, et cetera. Because one of the things we're seeing is that most oil and gas companies, while they're paying lip service to that carbon transition, they're just spending a tiny fraction of revenue on R&D associated with that, as opposed to really thinking about how do they manage a pivot. So I think that's a key area. Another example is to look at the consumer packaged good space. We've seen companies begin to make the pivot, like Unilever and PepsiCo, and companies like Kraft, which has not. And Kraft is actually owned by, mostly by 3G, which, as an investor, has focused on a strategy more of doubling down on reducing costs, basically. And so there's been no money into R&D around sustainability and nutrition. There's been no focus on investing in sort of the making the pivot to more sustainable products that consumers actually want and underperforming massively, right? So I think that kind of traditional investor approach of let's just figure out how to reduce expenses as much as possible, improve our margins and the short-term returns to shareholders is really destroying more value than it's creating, and that investors need to really focus on supporting board members who are going to look for a more value creation orientation that includes ESG sort of embedded in the business strategy.
And that gets back to the kind of ongoing tension between short-termism and long-termism, right? So those companies that are looking to manage for long-term value creation versus those that are looking to just generate short-term returns for short-term investors. And what do you see as the role for boards to play in navigating this tension?
Well, so first of all, I think increasingly boards are recognizing that the short-term investors are actually a small portion of their investors, are the loudest oftentimes, and they're the ones that sort of in terms of analyst calls, you tend to have more of the short-term focus. But a big portion of their holdings are by the long-term investors, also by passive investors like Vanguard funds, et cetera. And I think that therefore the board needs to pay more attention to the long-term interests of the majority of their shareholders. In addition, what we're seeing is that ESG is really creating short-term value as well as long-term value. So another set of research we're doing is called ROSI, Return on Sustainability Investment, where we've been working with big companies and everything from pharma to apparel to agriculture and so on. And what we're finding is that these types of investments are generating a lot of intangible as well as tangible benefits, right? So things like an automotive company's waste reduction strategy, operational efficiencies resulting in about $285 million annually benefit for that company's bottom line. And that's something that you can, make happen very quickly. Another is around employee productivity and retention for companies as there's a war for talent. And what we're seeing, for example, with the work we did with REI, the apparel company, that through their purpose and sustainability strategy, they had higher productivity and higher retention rates, which translated to about $34 million annually of benefit for them. There's I think a real argument for boards to understand that there are short-term financial returns, as well as it's important to acknowledge that the long-term viability of the company is the most important thing for virtually all of their shareholders.
The research that you've cited talks a lot about protecting downside financial risk, but I wonder if there's an opportunity here to look at what we call the impact alpha opportunity, the outperformance by looking at the impact considerations. And do you see that possibility of boards looking at these considerations and having the capabilities to look at ESG factors, not just to prevent negative downside, but potentially to look for positive upside?
Yes, we think that through our research, we've done some other research around how do you incorporate ESG into your quarterly calls and guidance and reporting, as well as how do you add the financial returns to your ESG reporting? Because right now they're completely divorced. You have your ESG, quote unquote, non-financial disclosures, and you have financial disclosures, and nobody's really tracking how the two interact. So I think increasingly investors will be asking for that interaction, and board members need to be asking for it now so that they're well prepared. And what we're finding is that the CFO's office is not really set up to track and understand the financial value being returned. So that waste reduction that I talked about with the automotive companies, for example, a lot of that benefit was through recycling paint and solvents because you no longer have to buy the virgin stuff. You're no longer paying the waste disposal costs. And actually, they were selling leftover stuff. Nobody had the ability to kind of pull together all that data and tie it back to the waste reduction strategy. And we're finding that over and over and over again with every type of company that we work with, that they're not tracking those financial returns. In addition, when you're looking at quarterly calls, we did some work with about a dozen companies to understand how you might bring ESG into quarterly calls. There we found that, again, analysts understandably are not really interested in, how your greenhouse gas emission reduction. But if you say our greenhouse gas emission reduction is helping us through driving innovation of new products or services, right? These commitments or it's created more operational efficiencies for us, or it's improved our supply chain resiliency, which we found in sort of during COVID. There's a series of benefits that you can monetize and demonstrate as important. And I think the board really needs to be have a separate committee around ESG and begin to really understand this return on sustainability investment.
And so, what do you see as the biggest point of leverage for stakeholders to take action based on the findings of this research? Where do you think the most impact can come?
Well, I think investors clearly can have a huge impact on composition of boards by demanding, as they're doing now, more diversity, and they can demand more diversity in ESG credentials. And also, I think organizations that are service boards need to start incorporating ESG training and courses into their course offerings. There are a number of offerings out there. Competent Boards has ESG offerings. Series now has a course on this. So I think there's no excuse. Board members can get trained up on it, and investors should be asking to see that they have been. And I think as well, investors should be looking at the governance structure. So in addition to the credentials of the board, are they just grafting ESG or sustainability onto the governance committee? Or are they so where there's already a huge agenda, or onto the audit and risk committee or whatever? And instead, are they really creating a dedicated unit that then interacts with and supports the team members in the company, and that there really are champions at the board level for ESG within the company is also really critical for investors to put pressure on. And I think as well, consumers and others and regulators can put pressure on these topics too.
That's great. And what's next for you? What's your next research you want to take on?
Well, we have a lot of different research that we're taking on. One is finishing up a report around the correlation between good ESG performance and good financial performance. That'll be coming out shortly. And then this year, I'm working on some research looking at private equity and its impact on sustainability in terms of the current way much of PE is run, where you're looking to reduce employee or headcount, you're looking to externalize, costs. Very interested in sort of the outcomes of that, where we're seeing, for example, PE-owned health companies delivering higher cost stays with worse medical outcomes. So there's a variety of different topics that we're going to be exploring in terms of our research over the next year.
That's great. Well, we'll look forward to following that research. Professor Whelan, thank you so much for taking the time to be with us today.
Thank you so much, Brian. It's been a pleasure.
That's going to do it for your Impact Briefing this week. You can read all of these stories at impactalpha.com. Impact Alpha's podcasts are available wherever you listen. They are made possible by Impact Alpha subscribers. Join them and receive the daily brief and full access to Impact Alpha's content. Podcast listeners get $100 off their annual subscription. Go to impactalpha.com/subscribe and use the code BRIEFING100 for $100 off. Thank you for listening, and thanks to our guest this week, Professor Tensie Whelan. Thanks, as always, to our producer, Isaac Silk. I'm Brian Walsh, head of Impact for the fintech company Liquidnet. Until next time, take good care.